This is InvestTalk. Independent thinking, shared success.
Hey, Justin Luke. This is Aaron from Livermore, California. Just wanted to see what you think about Herc Holdings, HRI. Thank you.
Interesting. Herc Holdings, Malaysian-based holding company, provides cash, rebate, digital advertising, and payment solution business ecosystems. Okay, very interesting. $3.5 billion market cap. Let me pull this up on a couple of my systems here. HRI is the symbol. And the first thing that stands out to me is that it's a foreign company. I'm liking a lot of those typically foreign names. And now this one has pulled back dramatically, down 4.7% on the day. It's down, 50% from its 52-week high, which was at 246. Now we're at 125. Okay. Now, it was trading at about market multiple then. Now it's trading at about 10 times forward-looking earnings, which seems cheap. You know, I like that. Let me take a look at the... on an earnings basis, it looks cheap. But on a free cash flow basis, that's suddenly turning... Well, it's been kind of vacillating between positive and negative for a while. And it's about flatline now. $16 million on a $3.5 billion market cap. Has a lot of debt, $4 billion in debt. So that's my issue here is based on earnings projections, it looks cheap. But based on cash flows, it does not. Okay, and then you have the chart reversing in such a dramatic way. Let me pull this up on a different system again. I have a lot of systems here. If you're watching on YouTube, you'll see most of my systems. And yeah, this has a lot more downside to go in my books. I would pass on it. I just don't like that momentum. It's acting more like a growth name. It looks cheap based on earnings, but it's not cheap based on price to cash flow, for example. And for that reason, I'm out. I'm passing on Herc. Okay. Now let's go take a live call. James from New York looking at CVH.
Oh, good evening. Actually, I was looking at CVE, Cenovus Energy, with the...
Got it. Okay. CVE. There we go. Okay. You own it or looking to buy it?
I mean, it's on my watch list, but I think that these energy names are really just going through some bloody times, and I don't know if the case like Cenovus, does it ever get to a point where it's a good time to buy, or does it wither away to, like, very little value?
Well, there's certainly risk in these names, but what you're actually seeing, what we like about some of the oil names is the fact that a lot of the bad news is already in, and what's underappreciated right now is actually shale growth is starting to turn negative in the U.S. It's kind of been the swing producer, and there's just been a lack of investment, and obviously prices haven't gotten to levels that are would incentivize a lot of shale drilling. And I think overall that's positive. Now for Cenovus, you have an extra layer of risk here, and that's the fact that it's a Canadian company, and it does have some refining operations in the U.S. So it's a bit of a positive. But obviously the Trump tariffs and how much that applies to oil certainly could be a big factor, and that's still kind of a lot up in the air. And but with that comes a lot of opportunity in our mind that. It's unlikely to be as bad as the market is expecting because we need the oil. If you don't have Canadian oil and those prices go up, not only are tariffs in general inflationary, but the, adding oil on top of that people will feel it. People feel the price of gasoline and oil more acutely than even tariffs on and TVs and electronic goods and things coming out of China, right? And so this is the thing that will affect them most directly. Our refineries are designed and to handle Canadian oil, and so we fade the idea that'll actually come to fruition. If there are Canadian tariffs, it'll likely be an exemption for oil to some degree, or at least a big reduction in our mind. And so that's why we think this is a good opportunity, but it's certainly not without its risks. That's for sure. So I like what you're looking at. Cenovus is certainly one of the better Canadian oil names out there. but you have to understand that risks that, and that's your call, whether or not Trump will certainly follow through with the Canadian tariffs and keep that on oil as well. Now, you probably already know that we receive finance and investment questions via the comment section over on our YouTube channel, and let's tackle one of those now. Shawnee Boy says, I like the podcast, but really like seeing what you are looking at while you give your opinions on the YouTube channel. I'd love to hear your feedback on Lincoln Financial. I have a full position on now with the recent pullback from almost 40 to the mid 30s, and would really like your thoughts on not only the technicals, but the fundamentals as well. All right, looking at Lincoln, he said Lincoln Financial. I believe he was speaking of, if I remember correctly, there's an insurance company, Lincoln National, I believe. Yeah, there we go. Yeah, because this is trading in the mid 30s. So that's LNC is the symbol. LNC is the symbol. This is Lincoln National. Now, it's an insurance. It operates a insurance and a retirement business. Okay, so it has the annuity business, retirement planning, life insurance, group protection, et cetera. It also sells fixed and indexed annuities and all of that. The problem with this is that it's been in a pretty strong downtrend for a while. Let me pull up another chart here. So if I look at the weekly, it peaked out in 2021 at about $76 per share, went all the way down to about $20 per share, and now it's at 34. So it's been an uptrend. It's since that bottom back in early 2023, but everything's kind of been an uptrend. So why was there that big downdraft? That's what worries me a bit, is the longer term downtrend that you're seeing here. They are taking their cash flow and buying back stock, but the cash flow is turned negative. Now it's rebounding a little bit, but it's generally been negative for a while. So, I just think there's better opportunities out there in the insurance space. I don't mind the business, but I just don't like that longer term trend. I just think there are better opportunities. So I'd pass on Lincoln National, not financial. Thanks for the question. And for all of you, head over to our YouTube channel so you can see the charts and the data that we are looking at.
Stay informed and stay empowered by visiting investtalk.com today.
All right, let's go talk to Mark in San Diego. Wants to talk about oil and energy.
Yes, I got about 10% of my overall portfolio in various ETFs and some big oil stocks, but I know they've been taking it on the chin for a while. So is it time to get out or just hang on for the long term?
Well, I mean, hey, there's you're talking about get out in the short term, medium term, long, could there be more downside in the near term? Absolutely. I do think over the medium to long term, there's some great values that are out there. I don't think this green energy transition is going to be as fast as everyone thinks. The demand for oil is, I think, likely to stay relatively robust and continue to grow, especially when you have, if outside of the financial crisis, global demand for oil continues to go up despite money flowing into green energy products, et cetera. So I'm bullish long term.
Okay. Yeah, because I got in back when they were giving away the oil barrels. It was so cheap years ago, but it was massive gains and slowly calmed down. So that's what I was wondering.
Yeah. Well, usually when I get these calls, it's usually a good time to buy. Nobody calls worrying about selling when, the price is up. So take with that what you will.
Okay. Thank you.
No problem. Let's keep things moving and get a fresh question from the comment section over on our YouTube channel. Riverdog Savior says, do you see the market pullback as far as the last time we had a tariff war? This is actually a good point. Now, a lot of people might say, well, what tariff war? Like, we didn't really have, Trump in his first administration, he had a good market, right? Market was good. And that's certainly true. Market was generally positive. But it wasn't always positive over those 4 years. You had some pretty significant pullbacks in the market over the 2016 to 2020 timeframe. Okay. Now, if I go pulling back the chart here, the most significant one really was starting in the fall of 2018 into kind of year end. As pretty much the fourth quarter of 2018. And that's when the S&P went from about 2,900 down to a low around 2,400. So that was a 20% drop roughly in the S&P. Could you get a 20% drop from the highs on the S&P? I don't see any reason why that's not possible. There's no reason why that's not possible. Could you get back to the yen carry trade unwind lows last summer around 5,100? Once again, I don't see any reason why that isn't possible. So if I head over to a chart here, the breakout high from 2021 on the S&P was right around 4,700. Okay, 4,700. So that would be about 900 points from here. And we've already gone down. What do we go down? We're at 6150 was our high. Now we're at 56 or so, 5,600. So we're about 550 points from the high. About approaching that 10% level. It would not shock me. Then does that mean are we going to go there right away? Probably not. Right? There's usually bounces along the way. The tariff situation, there's no real way to cut it besides it's bad for the economy in the short term. Now, you could argue the long-term effects. You can argue that, this is to restructure our economic system and bring more manufacturing home. That's certainly possible. Now, my take is it's going to take more than tariffs. You can't just rely on tariffs and think that that's automatically going to make production in the United States more competitive. I think it's going to take more than it's going to take industrial policy. Think of the CHIPS Act and how that spurred a lot of investment in the United States. Look at Taiwan Semiconductor trying to build chips in Arizona, Ohio, etc. And obviously, I think most Americans would say that's great. But you see, there's a big problem with that, is that it's not just about investments. It's all about talent. How many Americans know how to build chips, work in chip factories? Very few, because we don't really produce chips here. So you need education to go along with it, to train workers. Tens of thousands and hundreds of thousands will need to be retrained coming out of industries that are old and tired and retrain them into these new industries. And so this idea of producing more in the United States, depending on the way you think about it, it might be good. But from a logistical standpoint, it's going to take a long time. Which means in the near term, tariffs are just a hit, right? A hit to the economy. It's a tax, and it's a regressive tax, right? Because you're on physical goods. And these are things that the lower income consumer is going to feel a lot more. If you're upper middle class to wealthy, your TV costs an extra 20%. The gas, your gas at the gas pump costs a little bit more. The clothes on your, that you go buy from the mall costs a little bit more. You're not feeling that. Your disposable income is high. Just eats into that a little bit. But for the average consumer, it's a big tax. And we know the average consumer is already struggling a bit more than they have been since COVID started in order to pay their bills. And so, can we continue to the downside? Absolutely. Can it be 20%? I see no reason why it can't. And I would argue it'd probably be a little bit bigger. because we're already starting from a little bit higher of an excess with all these. Think of, the NVIDIAs and a lot of the Mag 7 trading at, 40, 50, 60 times multiples. And so to get to a reasonable multiple, maybe in the 20s or low 30s, a lot of these have to go down 50%. And they're a large part of the index. So a broad 20, 25% bear market would not shock me. Let's take a live call. Jeff from Kansas looking at Steel Dynamics, STLD.
Yeah, so I'm looking at the price of the stock. I know everything's been down lately, but it seems to be taking a bigger hit than a lot of the indexes. Trying to figure it out because steel prices are actually going the opposite direction. So it's not really, and I know that's a lot because of the tariffs, but I don't know if we think that's short term, long term, and I know that has to do with politics and everything that goes along with that. Mm-hmm. But I'm just trying to make sense of why it's going in the opposite direction of the steel price.
Well, you have to remember, first off, this is in the material sector. Okay. And historically, materials are just volatile. They're more volatile than the market. So naturally, you're going to get big moves in both directions. Now, today it was down 4.4%. Certainly a rougher day. But it's still above where it was its bottom back at the beginning of the year. Right? It's still up on the year. Whereas the broad indices are down. So it's outperforming. It just has had a pretty hefty pullback over the past week or two. But once again, that should be expected. You should expect that level of volatility. If you want low volatility, this is not where you want to be. Okay. Now, you could judge that, hey, Steel Dynamics will benefit because of the protectionist policies of the Trump administration, etc. You could argue that. But then there's the counter that, once again, this is negative for the economy. And typically steel demand goes along with the economy. Okay, so, maybe less competitive pressures, but more economic pressures. And so which one kind of wins out? I think the market, is battling that right now and trying to figure that out. So, I don't love steel as a business. It's usually, there's not a lot of competitive advantages here. But I've said for a long time, there are two clear standouts in the space, which are Steel Dynamics and Nucor. And this is one of them, right? So, if you want to own steel, you're in one of the better names, but understand that it's not without its volatility. It's still going to be very volatile because it's a cyclical name. Okay. Thanks for the call, Jeff.
We appreciate you watching.
Don't forget to like this video and subscribe to our channel for more content.
Hi, this is Duncan from New York. Thank you for all that you do. I am calling on stock ticker /ETF EUAD, Select Stocks Europe Aerospace. Reason why I'm looking into this is because, well, if America is coming out of the assistance for helping Ukraine, Europe is supposed to step it up. And I think I just read that Europe is putting about like $800 billion into more manufacturing for defense. So, one, would this make sense? Two, I bought some. I'm thinking about buying more. This is hoping to be kind of like a medium to long-term play, but looking to see what you guys say. Thank you very much and have a great day. Bye.
All right, this is EUAD, a new ETF. And typically, I don't love these new ETFs, but this one I actually kind of like. It's not easy to gain exposure to these European defense contractors. And this is kind of an all-encompassing, easy way to, you don't have to go and do deep research. You just buy a basket of them. And it's already done very well since it started just a few months ago. Let's see, it's already up about 33% year to date. And it started trading, when was that? In October. And it just kind of bounced around the 24 level until it started breaking out into in late January, and then it's been kind of exploding higher. Now, nice little pullback today, maybe a bit of a buying opportunity, but I like this. It's probably a small exposure, not a bad way to get access to, a place where more and more countries are going to have to start spending on defense. Now, let's pivot over to another topic, kind of ancillary to this, and this is the fortunes of Tesla. The Tesla's gains from Trump's inauguration have almost fully reversed. Have they fully reversed now? Let's take a look here. Yeah, they're almost there. Actually, no. Yeah, they are. Yeah, they're actually completely reversed, because if you go to early October, it was trading at about $238 per share. Now we're at $222. And this is all because of Trump's movement into the White House, into supporting President Trump. And this is not a political statement. This is just the reality on the ground here, is that he's alienating a lot of his buyers. Automotive consulting firm Strategic Vision found that 22% of car shoppers surveyed said they would definitely consider a Tesla for the purchase of the next vehicle back in 2022. This is in 2022. So that was similar to Mercedes-Benz, BMW, and it was kind of on that level. Well, as of last summer, before Trump was inaugurated and before Elon got in the White House and the whole Doge thing, it had dropped to 7%, from 22 to 7. That's in line with brands like Lincoln and Dodge. Okay. Now, as of December, 63% of those surveyed said they wouldn't consider buying a Tesla, a 10% drop from the year before. And it's already been a company that has a, up and down operating history. And it had a very old vehicle lineup, but there's been really a true refresh of the Tesla lineup for a long time. We know they have quality issues and the resale values are really bad. So that's all been kind of weighing on the brand. But now this move by Elon has just kind of pushed a lot of his base of supporters off a cliff. Remember, Elon a decade ago was the darling of the left, right? He was the one, and I've had a lot of critiques of Elon throughout the years, well before anything political that he ever did. And but if you want to give him credit for something, it's making EVs a real thing and proving that you can build a car company just by selling pure EVs. And a lot of the other companies pivoted, right? But that made him the darling of the left. And so many Tesla owners are on the left politically. And now that's shifted dramatically. Tesla's new vehicle registrations in Germany fell 76% month over month. In France, down 26%. And the shipments of Tesla EVs out of China, down 49%. And so it's really upended this company that already had some issues. And this could end Tesla for good at some point. Because of, I've always said, car companies are very difficult. They're highly capital intensive. And if this sales trajectory holds, it's in for a world of hurt beyond what it's already feeling. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And enter our second annual InvestTalk Market Madness competition. It is underway and you can win $1,000. Just head over to InvestTalk.com and enter by March 17th. And if you need help with your portfolio and your broader financial situation, finding a path forward that makes sense for you and your goals, don't hesitate to reach out to us at InvestTalk.com. Click on the portfolio review button. Independent thinking, shared success. This is InvestTalk. Good night.